All right, let's talk about a mental shift that can literally change your entire trading career. We're going to flip the script, move away from that tempting question, hey, how much money can I make on this? And instead, start with the one that actually keeps you in the game. Okay, what's my worst case scenario? How much can I lose? This right here, this is the core of a risk-first mindset. This quote, it's a peek inside a professional's morning routine, and it's so powerful. It's this moment of self-awareness where you look yourself in the eye and admit that you, yes you, are capable of messing things up before you even place a single trade. This isn't about being negative. It's about being humble and respecting the market every single day. And that ritual really boils down to this one crucial question. You know, it's so easy to blame the market for our losses, right? Oh, there was a sudden drop or some bad news came out. But what if the real risk, the biggest variable you have to worry about, is the person staring back at you in the mirror? At the end of the day, stocks don't manage themselves. You are the portfolio manager. Your number one job isn't to find winners, it's to protect your capital. So when things go wrong, it's almost never just the market's fault. It's usually a breakdown in our own discipline, our own preparation. The responsibility and the power, it's all on you. Okay, so let's break down the most common trap that catches pretty much every new trader. It's what we call return-first thinking. It's this fatal flaw where you're so focused on the potential reward, on that big win, that you completely ignore the risks until, well, it's way too late. And this comparison just lays it all out, clear as day. On the left, you've got that amateur return-first mindset. It's all about greed. How much can I make? You get impatient, you jump into a trade with absolutely no exit plan. But on the right, that's the professional. The risk-first approach starts by looking at the downside. How much can I stand to lose? That forces you to be disciplined, to have a clear plan, and most importantly, to know your exit before you even think about hitting that buy button. So, how do we make that switch? How do we get from the left side of that chart to the right? It's all about adopting the professional's creed, the risk-first mindset. This is the whole philosophy that protects your money and makes sure you get to stay in this game long enough to succeed. And you know, it really is that simple. Think of it like a poker game. Your trading capital, those are your chips. You could be the best poker player in the world, but if you run out of chips, you're out of the game. It's over. Survival always comes before trying to hit that jackpot. And the number one tool for survival? It's the stop loss. This is your safety net. It's a price you decide on before you trade, where you say, okay, if it hits this point, I was wrong. No questions asked, no emotion, I'm out. It takes the decision out of your hands when you're under pressure. I love this metaphor because it's just so true. Would you ever drive a car without brakes? Of course not, that's insane. Well, that's exactly what you're doing when you trade without a stop loss. Yeah, you might get away with it for a while, but eventually you are absolutely 100% guaranteed to have a huge crash. It's not a matter of if, but when. Now, I know what you might be thinking. I don't need to put in an order, I'll just use a mental stop. Big mistake. A mental stop is just an excuse. It's way too easy to cheat, to rationalize. You'll watch the price blow right past your mental level and you'll say, oh, I'll just give it a little more room, or it'll probably bounce back. And that is exactly how a small, manageable loss snowballs into a giant, account-crippling disaster. And if you need more convincing, just look at the math. The math doesn't lie, and it's absolutely brutal. If you lose 10%, you need to make 11% back to get even. Okay, not so bad. But if you lose 25%, now you need a 33% gain. And look at this. If you let a stock drop 50%, you need to find a 100% winner, a double, just to break even. This is why you have to cut your losses when they're small. The deeper the hole, the harder it is to climb out. So we've got the rules, we've got the math, but that's the easy stuff. The real challenge, the real battle in trading isn't against the market. It's the one that's fought right between your ears. It's about conquering your own worst enemies, your ego and your emotions. And this leads to something we see all the time. It's called becoming an involuntary investor. You know the story. You buy a stock as a quick trade, it immediately goes against you, and suddenly, to avoid the pain of admitting you were wrong, you tell yourself, oh, you know what? I actually like this company for the long term. You're just rationalizing a bad decision. And let's be blunt, your ego is the culprit here. It's what makes you stubbornly hold on to losers. For so many people, the psychological need to be right is even stronger than the desire to make money. And it's that ego that refuses to take a small, smart loss and instead lets it turn into a massive one. So, how do we actually build this discipline? How do we beat the ego? Well, let's look at some lessons from the real world, starting with a great little story that really brings this whole idea to life. So, this story is about a horse, but it's not really about a horse. It's a perfect metaphor for dealing with those super volatile stocks, the ones that promise a fast ride but are incredibly dangerous. The story goes, as a kid, our narrator decides to ride this notoriously wild horse, Black Orchid. The second he gets on, she just bolts, makes a beeline for a tree, and bam! A low branch just sweeps him right off her back. A fast, painful, and totally out of control ride. Now, you'd think he'd have learned his lesson, right? Nope. A few months later, he gets on her again. This time, she starts bucking like crazy, throws him clean off, and then, to add insult to injury, she runs right over him. The punishment for repeating the same mistake was even worse. And here's the punchline. He's lying on the ground, totally dazed, looks up at his uncle and says, "Uncle John, did you see how fast I was going?" He was focused on completely the wrong thing. And the lesson couldn't be clearer. Speed, or in trading terms, potential returns, means absolutely nothing if you can't stay on for the ride. That stock that could double is worthless to you if its volatility shakes you out for a loss first. You have to learn to leave those black orchids, those super volatile gambles, in the corral. This all brings us back to what you can actually control. And when you look at it, there are really only 4 things. Notice something here? 3 of them, what you buy, how much you buy, and when you buy, all happen before you're even in the trade. Once you're in, there's only one thing left you control: when you sell. That just shows you how incredibly critical that one decision is. And to make that selling decision correctly, you have to accept this one fundamental truth. The market is never wrong. Your opinion might be wrong, your analysis could be wrong, your hopes are definitely wrong. But the price on the screen, that's reality. Accepting this allows you to check your ego at the door and just react to what the market is actually doing. And that really brings us to the final question, the one you have to ask yourself. The next time you're holding a losing trade, refusing to sell, ask yourself this: am I still on this trade to make money? Or am I just trying to prove I was right all along? Be honest with yourself, because the answer to that question, well, that's what's going to determine your success in this game.